Thanks very much for the chance to present to you all today. What I'm going to try to do is to talk about some of the lessons that I've learned, and I think the industry's learned from the global financial crisis, and also provide some ideas about how portfolios might be different in the future. The first one that everyone's talking about, and I think is probably the most obvious lesson, is about asset allocation. It's getting a lot of press, and I guess I wanted to really sort of say that it's not about short-term market timing. It's very much about recognising that every asset has a price at which it's good value and you've got a good chance of making a good return, and also a price at which it's expensive and your future return stream is compromised. And if you think about the old days of set and forget, I think those are well and truly over. We do need to be much more vigilant to asset allocation, to valuations, to pricing, to the market around us. That's led to some new terminology. We now are calling it DAA, seems to be what the industry's settled on. It was MTAA for a while, but that was a bit confusing with the Motor Traders Fund, so now it's Dynamic Asset Allocation. And DAA is the new SAA, and it's not TAA, which is Tactical Asset Allocation. One of the biggest challenges, I think, in all of this, though, is learning how to sell. Everybody is a better buyer than a seller, and if you think about your own personal stocks and things you might buy, if you think about anything else, buying a house, buying anything, it's very hard to be a good seller of something, much easier to be a good buyer of something. So learning how to sell, especially when something has been performing very strongly, is a lesson we needed to learn. We should learn a bit more, and I think more of that is probably going to be something we see in the future. So what is DAA? Why is it different? If I think back to when I joined the industry, which I'm sad to say is probably about 20 years ago now, it seems to have gone very fast. We used to do SAAs by simply having a set of long-term capital market assumptions. We would use those. They were typically backward-looking. They were based on what the markets had achieved over a long period. We would set the strategic allocations, and then they would be left, and they weren't modified through time. The 3-year review cycle was pretty common for those of you that were around back then, and there was no allowance for the market environment that we operated in. What DAA does is basically sit and say, well, what environment are we in? Is it cheap? Is it expensive? What's the relative sense of valuations of things? To what extent are our objectives going to be compromised by the environment that we're in? Where are the risks and opportunities? And just because you review something regularly doesn't mean you change it regularly. And that, I think, is the difference between dynamic allocation and tactical allocation. I think dynamic is reviewing regularly and changing in response to perceived risks and opportunities. Tactical is where you change regularly. And that's one of the key points of difference, which is why DAA is not the same as the old tactical asset allocation. So what sort of information can be used? There are lots of things you can use to help provide signals into what markets are doing. I've got 3 there. Valuations obviously are key. How expensive or how cheap something is. You can look at fund flows. So this is a measure of investor sentiment. If something's quite attractive to other investors, that will push the price up, and vice versa. And you could look at sentiment. And for those of you that were here this morning, discussion about the 2 presentations at CMSF, and that one was very, very bearish and one was a bit more moderate. But at that time those presentations were given, the sentiment was very, very bad. And so that did influence people's behaviour, and certainly sentiment had influenced markets to that point as well. So I've got a couple of pretty simple examples to show you. It's not like people sit around and look at this one thing and then do something to their portfolio. This is just one input that people can look at. What I've chosen in this case is the Aussie dollar versus US dollar. This is a long-term purchasing power parity model. You can see post the float that exchange rate range trades pretty much between 60 and 80 cents. So there's not much to do between those levels. That's pretty much noise at that point. But you can see there are clear times when it reaches those ranges, and if we think back to last year, the dollar was around 98 cents. It was clearly expensive at that point, and on balance the risks were to the downside. Now it could have kept going. In fact, there were calls that would go to parity and beyond, but instead it peaked, I think, at around 98 and then fell very, very rapidly back towards its long-term average at that point. So at that point, as it's breached those ranges, that's a strong signal that you need to do something. And in this case it was to reduce your hedging to capture value as the Aussie dollar fell. Now this is not a short-term thing. For example, if you have a look at the path of the dollar through time, it moves about all the time, every day, in fact every second really. But if you do see medium-term signals of overvaluation, undervaluation, it can be a very valuable thing to do to shift your portfolio to respond to that. The next one is about the Aussie equity market, and I've decided I'm not going to say selling anymore, I'm going to say taking profits, because I think that sounds better. And I think it's something that's a bit more palatable to say I'm taking profits rather than I'm selling. So what I did was look back over 10 years and say if I had $10,000 invested in the share market in June 1999, what would I have had at the peak? And at the peak, which of course now we know was October 2007, that $10,000 has gone up to $31,000, 14.8% per annum. Now equities don't go up by 14.8% per annum for the long term. Equity markets don't perform that well over time. And when we look back now at what happened 20 months later, you can see that you've given half of that back. The 10,000 has gone to 20. So you've gone from 30,000 back down to $20,000. So that half of that gain you've given back. And you've dropped down to a return for 10 years of 7.1% per annum, which is a much more normal return from equities, but it does represent a big change from the situation less than 2 years before. So if you're actively looking at the risk and the valuations through that time, you can just mitigate against being too fully weighted at the top of the market. The second lesson, I think, is around liquidity, and a lot of people have talked about that this morning. I think it's just a very good reminder that illiquid means illiquid, and also that sometimes liquid can become illiquid. We saw that in some parts of the bond and equity market. And I think one thing that the funds need to think about is not only investment risks that apply to liquidity, but also other risks. So think about your membership, what affects the growth in your membership. Do you have aggressive predators? Do you have members who are interested in member investment choice and switching? Because all of those things will lead to different liquidity requirements and liquidity patterns through time. The other thing, of course, is we've seen a lot of interest by APRA on valuations, and there's no sign that that will change. So I think transparency about valuations and liquidity management are two important parts of the new way of managing portfolios. Liquidity planning is something that we probably all could do better. I know that certainly for our part, when we thought about client portfolios and we had cash flows coming in, and it does make you a little bit lazy because you think it's fine, it's a fast growing fund, I can just use cash flow to shift the allocation. And the reality is most of the time that is true. But when it's not true, and for example cash flow comes in but it's all going to cash, as in the members are saying I want my option, my MIC money to be in cash, you don't have as much control over the asset allocation. So there is a limit on unlisted and illiquid investments, and it will vary from fund to fund. But it would be a shame if all this focus on liquidity meant that we invested less in that area, because they typically are very good assets and do blend very well with super fund liabilities, which typically are long term. So what we sort of suggest for clients and for funds is to have a liquidity plan, to stress test it, to include a range of things in it, and think about liquidity on a regular basis. Risk and the definition of risk, I think, is another thing that will need to be rethought in this brave new world that we're in, or that we're moving into. The reality is that when you ask people what risk is, everyone's got a different answer, and risk means different things to different people. So what I think that would be important to do is to think about what risk matters the most. And I've listed some here, the ones that I think make more sense from a member's perspective. And sometimes what matters for a member doesn't necessarily matter for the individual trustee. For example, a trustee sitting around the table has a look at the survey, sees their fund versus other funds. It's not necessarily the case then that a member will do the same thing. So I think recognising what the member is most concerned about, in my view, that really is the ability of them meeting their financial obligations, not achieving real return targets over time, rather than short-termism, underperforming peers, and headline risk, for example. There could well be others, and I think they need to be tailored for each fund. One of the other things that people are talking a lot about is portfolio construction, as though it's busted and we should start again. And I've got to say on this one, it's not clear to me that the old way is totally busted. Maybe that's a bit controversial, but if you look back over 10 years, you do see some funds that have achieved the CPI plus 3% target, 3 to 3.5% target. That's what we're meant to be achieving. If we could do that over the investment life of a member, then we will have done a good thing for that member. In the last 2 years, we have had the worst environment for 80 years, and sure, some portfolios did really badly, but some of them didn't do too badly in the scheme of what actually occurred. And if you look at the long-term track record for a lot of those funds, it remains on track relative to CPI objectives. And maybe the lesson is that the CPI target is actually a lot harder than we think. And at times it seems easy when equity markets go up by 20% a year. Certainly it seems very easy, but I think over time that's proved to be a bit of a stretch target. That said, the only good thing about the global financial crisis is that you can learn lessons from it, and I think we do need to think about some things we could do better on portfolio construction. One is what I've loosely called threads of risk, which is really more of a factor-based understanding of risk. It does need sophisticated systems, but it also needs a lot of common sense. There are a lot of sophisticated investors who had very sophisticated models, but not a lot of common sense, and those are the ones that seem to blow up the most. So a blend of systems and common sense and understanding where the risks are through the portfolio, I think will stand the funds in good stead going forward. Another lesson I think is about transparency, and there's been some comments made already about this. Some structures and some product designs and some responses should just be simply unacceptable. If you've got negative screens about who you're prepared to deal with and what terms you're prepared to accept, you should use them. If you don't have them, you should develop them, and you should apply them in the good times and in the bad times. The problem with applying them in the good times is that you tend to get a bit slack because you think, oh, these are nice people, they're not going to do me over. But in 5 to 10 years' time, when things have gone bad and those people aren't there, all you have left is the structure you negotiate today. So my strong view is clients ought to negotiate strong structures that protect them today and will protect them in the future. I think just on an ESG related aspect, governance has been a big positive change in the last 10 years in many ways. The funds are more engaged, the companies I think are listening, but we saw some really terrible examples of very, very bad behaviour by some companies, so I think there's still a lot of work to do there. And the funds as the owners of capital are the ones that can affect change. Alignment of interest, and those of you who've heard me a couple of times in the last little while in these sorts of forums are probably sick of me talking about this, but like Ian Robertson, I've undertaken to bang on about it a bit. It's a big issue, alignment of interest. We have seen some incredible, and I don't mean that in a good way, examples of bad behaviour during this global financial crisis, and it's all about lack of alignment of interest and poor remuneration structures. And it just seems to me if super funds are the owners of the capital, then you need to work out how you should remunerate and align the people that manage that capital for you so that they look after your interests. Because if that alignment's not there, they'll look after theirs and not yours. Just on fees and alignment of interest, if you pay managers on the basis of funds under management, then a manager will rationally respond by increasing its fund under management. That's a perfectly rational business response. But that means that puts that firm's ability to generate excess returns at risk as they get bigger and bigger in most cases. Some strategies clearly are advantaged by scale, but not all. So it seems to me that there has to be a better way, and I would very much like to see a model where we had flat dollar fees, not a percentage of assets paid to cover costs, and that a performance fee rewarded excellence. And under this model, I actually don't mind if some managers get paid more if the returns are delivered, because my strong view is it's about net returns to members, and I don't have the same strength of view about having to have a particular MER as some people. To me, it's all about net returns to members. And I think that a new approach there would be very valuable. The other comment just on long-term mandates, again, this is something where I think the industry could make some really positive improvements. Of course, you do need to choose the right manager and have some get-out clauses, but long-term mandates where you give a manager time to implement their strategy and they then give companies time to implement their strategy, and this is related to, I think, to Martin's comments before in the earlier session. It seems to me that we will, I guess, release the shackles of short-termism and start to think about what we're trying to do, which is to invest very much for the long term. What worries me a bit is we talk about climate change a lot. Climate change is absolutely off the agenda during the global financial crisis. Nobody talked about it because it wasn't a risk today, but it is undeniably the biggest risk that we face. And it seems to me that if you are thinking about big long-term risks, you have to be able to invest for the long term and put in place structures to remunerate people over the long term. Just on short-termism, I've got a couple of charts. These aren't new, these are from Jack Bogle's work he did in 2005. It's about the holding periods of investments. This first one's not too bad. This is about the average holding period of US mutual fund investors. And you can see for a long time to the 70s it was around 10 to 15 years. It fell away, now sitting at about 5 years, so that's probably not too bad. But if you look at the holdings of stocks, you can see quite a frightening decline. Now some of this is because of high frequency trading and those sorts of strategies, but the trend is still pretty clear. You can see that for the bulk of the time to the 1970s, the average holding period was about 4 to 8 years. Now it's 1 year. So that's a huge difference. And if you think, do companies execute their strategies in a year? Does BHP have a 12-month plan? They probably do, but they also have, I hope, a 5 and a 10 and a 20-year plan. So if you think of what this means for the market and the pressure on companies, and then companies behaving more short-term, companies not investing for the long-term, you can see the impact on the economic growth potential of the economy. So, my lessons, I've learned some. I'm really glad to be learning lessons all the time. I wish I didn't have to learn these ones, but I think it's positive that we can learn lessons. The 4 that I've learned in particular, that selling is taking profits. Investors cannot afford to fall in love with assets or asset classes. They're not your children. You should not have any emotion about them. You need to be clinical and think about what it means for your future investment returns and risks. Liquidity planning is a big one. Alignment of interest is critical, and like-mindedness is important. You want to invest with people who think broadly the same way as you do about things. But even then, you can put in place the best protections. People will still lie to you when their backs are against the wall. And that's been a very interesting phenomenon in the last couple of years in some sectors. And finally, it's okay to say that you don't understand something. I'm happy to say it, and I say it at work, it's no big deal. Trustees should always invest in what they understand and understand what they invest in, because I think that those trustees in the last couple of years that said, I don't get CDOs and didn't invest, I think that that's a valuable lesson for all of us. Thank you.
Thank you very much, ladies and gentlemen, for allowing me this privilege to present to you a 20-minute presentation on lessons learned. I like that because I am presenting to you not as a manufacturer or provider, but rather really just as a keen student of history and finance. And I think that's quite important, specifically since what we're going to be doing here is, and at least what I'm going to try to do, is challenge some of the conventional thinking that's out there. And the reason for that is, I've always said, and my father always taught me that, a good question is much more valuable than an insightful, pontificated answer. So if in fact we are challenging ourselves and asking ourselves the right questions, perhaps, just perhaps, we will have the better answer when they eventually come out. But before I start, I want to basically start with a few rules of engagement. And why I say that is because there are going to be perhaps some controversial issues there that may challenge you, that may raise your eyebrow, that may give you a tisk. So before I do, I want you to at least present from where I'm coming from. Firstly, if the global financial crisis has taught us anything, it is like most debt, taxpayers ultimately underwrite pension benefits. I don't know any democratically elected government that will allow its agent to live on the streets. At the end of the day, someone's going to fund this debt that we call pensions. Likely, the bigger the debt, the more likely taxpayers ultimately fund it, or if you like, collateralize it. Superannuation has come out of a 20-year cycle of what I call wealth creation. And as demographics begins to shift, it will shift from a wealth creation to a wealth immunization and ultimately, of course, wealth distribution. Next one is that we are really coming from managing a period of volatility to managing a period under uncertainty. And this will be the real crux of my 20-minute presentations, and I'll go into a little bit more detail later. This one also is quite interesting. There is no such thing as a passive decision. There is no such thing as a passive investment. The moment you have decided to go out of an active equity or an active bond into a passive alternative, you have just made an active decision. And the longer you retain that active or passive decision, you are retaining that active decision therein. Economic theory is proactive and implementation tends to be reactive. So we all pontificate about the world and the state of the economy. We all pontificate and show charts of V-shape and what have you, but we typically sit and wait for the proof in the pudding before we realign our portfolios, as opposed to reading the tea leaves. And then lastly, and probably most importantly, and this has been harped on a few times, the next 20 years is highly unlikely to repeat itself, certainly over the next 20 years. We truly are in a whole new environment.
Toto, I have a feeling we're not in Kansas anymore.
So we're truly in a new environment, and we need to get comfortable with that new environment, because as we enter that new environment, we need to understand how we're going to manage it. And this is where I'm really going into this managing under a period of uncertainty. There I have two covers, book covers, that most of you may recognize. The more obvious one, of course, is Ben Graham, Security Analysis. Ben Graham, of course, being the father of value investing, the man who basically trained Warren Buffett. And the other one is a little bit less known, but equally powerful, and that's really by Nicholas Taylor, The Black Swan. And really, we've talked about this. The first one is about two schools of thought, if you like. One is the intrinsic valuation known versus the unknown unknown. What Rob mentioned, the unknown unknown. So let's go straight into that. Now, what I'm about to show you here is nothing new. Keith Ambecher and the late, great Peter Bernstein wrote many years back that profit cycles, or GDP cycles, are in fact quite important. But what's more important for the capital pricing is actually inflationary cycles. We've been taught that typically profit cycles, or GDP cycles, is every 5 years. We should expect a recession every 5 years. But inflationary cycles are actually much longer than that. They can last 20 years. A funny way to look at it is basically think of the tide. Low tide, high tide, hyper tide. That's the inflationary cycles, whereas the profit cycles is the boat, the speed of the boat to which it's moving within the tides. And really, if we look at the inflationary tides, Peter Bernstein and Keith Ambecher have shown us there's basically four. The more common ones, the more mean, if you like, is benign inflation, where inflation tends to be predictable. And the other is disinflation, where each year the inflationary figure is still high, but each year a little bit less so. Now, those benign inflation and disinflation is probably the best period for capital markets. Fantastic. Because if you think of inflation as a tax, it takes away or gives, it's actually quite important. The extremes, the extremities, however, is really the deflationary or depression, and of course, the rising inflation. And what I want to show you here, using Ibbotson data book, which, as some of you may know, it's a great thick book that has the asset prices for everything you could possibly think of. Large cap, small cap, value, growth, you name it, it's all there. Inflation, bonds, corporate bonds. And what I want to show you here is the great period. Fiona touched upon it before. If you look at benign inflation and disinflation, notice how the average rate of return during the disinflationary period of 1982 to 1997 was 13.5 real, with a standard deviation volatility around the mean, not a risk measure, I agree, of 4.1%. Very handsome. Also notice the correlation of equities is very positive to the most GDP, to bonds, and to cash. Economics 101, we know that. But again, if in fact we are truly entering into a new environment, this two-headed beast of inflation or deflation, then what are the ramifications? Because sometimes these words just come out of economists' mouths as though it's just, it's a deflation or it's a rising inflation. We need to understand that because the way we construct a portfolio in such extremities is going to be vastly different, and economic 101 rules fail under these periods of uncertainty. So actually, let me just show you what I mean by that. Here again is the disinflationary period. It's a 12-month real rate of return for the major asset classes, GDP, bonds, and cash. And what's striking about this figure is look how it's top-heavy. The predominance of the figure being above the zero line. So more often than not, actually we had real rate of return significantly handsome. And the way you made money under this great period was basically you dialed up the risk budget. The 70-30 balanced fund worked brilliantly well. Everything rose. You had periods of volatility, but the volatility was up, 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 a little bit down, up, 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 a little bit down, up, 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 a little bit down. Buy and hold and dialing the risk budget into more risky, a positively sloping security market line was the way to go. But what happens when you actually change that now to the extremities? Now remember I said before that Ibbitson's data goes back to 1920, so I'm able to look at capital market prices under the extremities of deflation and depression, vis-a-vis, of course, rising inflation. In this case, you can see here what I'm going to show you is that the real rate of return after inflation for equities wasn't that bad. But look at the standard deviation, the volatility of the annualized returns, nearly 10.5%. Now let's look under rising inflation. By the way, equities was the best performing asset class during this period. You make the most money with equities under inflation. It makes sense because if earnings goes up with inflation and dividends go up with earnings, ipso facto, you get something back. It's like a little bit of a hedge. But even there, equity market, which was the best performing asset class, only gave you CPI plus 1. So for those pension plans, superannuation plans who are targeting CPI plus 3, where are you going to get it? The best performing asset class under this period of uncertainty of inflation was equities, and that was only up to CPI plus 1. But more importantly, look at the correlations. What happens if bond yields go up and cash rates go up? Economics 101 teaches us that equity markets, through the cost of capital, drops. You get a negative correlation here with yields and prices. Bond yields drop, equity markets drop under deflationary cycle. Counterintuitive to what we were taught in Economics 101. Conversely, look at GDP under an inflationary period. The economy becomes more robust, people become more frightened that inflation is in fact out of control, and what happens to the equity markets? It falls. Inflation is like a tax, it takes away. But equally, look at the best and worst. Massive deviations. And more importantly, what I want to show you under the inflation in the 1970s is look at the more symmetrical relationship now over the rolling 3-year best and worst, even, plus or minus 45%. So the 1970s was in fact quite ugly. But it really wasn't that ugly. I mean, it was a great period of music, it was a great period of TV shows, and it was also a period where your fashion matched your tablecloth. But actually the other real ugly side of the 1970s is again using the Ibbitson's data. And there you see again that what I said before, a more symmetrical relationship, if you like, between equities and bonds. Plus years and minus years. You no longer see that sort of up, down, up, down. Now you see up and down, up and down, up and down by similar margins. Market timing in this, or the buy and hold, in that kind of environment, given the long-term real rate of returns were so poor, is highly dependent on when you come into the market. If you came in at the bottom of the cycle, then fine, the long-term trend rate was actually up. If you came in the middle, you made no money, and if you had the misfortune of going in when basically everyone says the V shape, it's time to get in, you lost money. So let's go into that. What I want to show you here can be perhaps a little bit controversial, and you might think, okay, Rob, you're an active manager, you're talking your book. I'm not, I am a student. And to me, this is important because in 1974, my dad started a pension plan. ERISA came in 1973, he started a pension plan in 1974. And 1974 was the start of an 8-year stagflationary cycle where everything lost money. And I remember my dad coming home, he's a lawyer, pulling his hair out. Because everything he tried to invest in was losing money. And here what I want to show you is you saw that the equity market was up, CPI plus 1. So what I've done here is using Lipper data, and as those of you who may know, Lipper data is basically, it tracks mutual funds on a net basis after fees. Now keep in mind, in the 1970s, you had very high fees. If you think the fees are high now, you should have seen 1970s. The transaction fees were also much more regulated, so the MERs were quite large. But even with these high MERs, What's interesting was that the index was 77th percentile, vis-a-vis the active management world. Now, if you look at, let's say, the peers on the average, the active value manager was actually was nearly top quartile during this period of extreme volatility. Why? Well, basically, in my humble opinion, in the 70s, a couple of things was probably more prominent, and if you'll excuse me for saying this, people bought low and they sold high. So we talked about the transaction, we saw the Jack Bogle figures of the transactions were much higher and lower and whatever they were. That's absolutely spot on. But isn't it interesting as well that the tracking error of the average US mutual fund in 1970s was 7.5%. The greats of that era did not talk tracking error. If they liked an investment, they held it. If they didn't, they did not hold it. So let's go on, and if we look at, again, on average now, what's interesting here is that the average active manager, in totality, in aggregate, on net returns, was up 2.8%, vis-a-vis the index at up only 1%. The tracking error, the standard deviation, even though it had much higher tracking error, mind you, 7.5 tracking error, the standard deviation was modestly lower. For the average, this is large actives, which includes value, core, growth. There's no style bias in these numbers. It's active, S&P versus the S&P 500. But I think what I find even more surprising is this next one. And that shows the average US balanced fund in 1970. Remember what I said before, how the equity market on average gave you 1% real over that whole period? A balanced fund was up 1.5% over that period. It was even better. Now, some of that may be due to the active freebie, but also some of that was due, if you recall what Fiona mentioned before, that dynamic asset allocation. People took profits back then. I made a lot of money, I'm out. My dad didn't hold it. My dad didn't, look how much money I made from my manager. Well, I made more money than I want, I'm out. I now reinvest it in some other place. People began to move. The buy and hold mentality under the extreme period of uncertainty forced you to react, to move. The onus was now on us as investors. So I showed you the one extreme of the inflationary cycle. I would love to show you a deflationary cycle of the US to keep like with like, but I can't. The reason I can't is, of course, the Lipper data starts in 1960s. Besides that, 1930s, of course, in the US, there really was no US mutual fund industry. But I can show you the same figures into a place where I lived for a while, Japan. I can show you the capital markets under the opposite end of the spectrum of volatility and uncertainty, called deflation. And by the way, if I can clarify something, the US really wasn't deflation, it was more depression in the 1930s. Japan really wasn't depression, it was more debt deflation, more akin to what we're seeing here in many ways. But really, forgetting the nomenclature you want to use, what's more important is look at the similarities between good and bad. Look at the symmetry between the average return period. Almost identical. What's even more telling is that, yet again, even the topics, the index, on a total return basis, was also nearly bottom quartile. Now, those of you who've ever been to Japan and met Japanese active managers, they're not necessarily the big gung-ho guys, you know? They're not out there going, okay, the punters and spivvy traders. They're very conservative. But even the topics index, using the Russell-Nomura database, which is a little bit more confined than, of course, the Lipper data, and it's not on a net basis, so I confess that's true. But even there, my point is that even the index was not necessarily the best place to be. The buy and hold strategy under periods of this uncertainty, deflation, inflation, where we just don't know what's going to happen, is actually a challenge to the status quo of buy and hold. And what I have there is, although the figures may be different, yet again, The similarities are there's a 2% outperformance by the average active manager. During the deflationary period of Japan, the index was down 4.5%, versus the average active manager was minus 2.7. So, I've always said this, in Japan, we may talk about here in Australia, the long-term equities go up by CPI plus 2 or 3, therefore 5 or 6%. Japan says the same thing. Only they say minus 6 or 7%. That's their history. So, to conclude, economic theory is proactive and its implementation tends to be reactive. I presented a lot of charts, a lot of figures. You've heard a lot of charts and a lot of figures, a lot of pontification of V-shape, U-shape, the alphabet soup of the economy. But ultimately, of course, a lot of us sit and wait until others begin to move. Investors tend to adapt managing volatility to managing under uncertainty. There was a pension industry in the 1970s, and it was okay. It perhaps didn't thrive as it did here, but it existed. There is a pension industry in Japan, and it exists. The largest pension fund in the world is where? Japan. There is no passive option. By looking to de-risk your portfolio from active into passive because of your frustrations, all valid reasons. And we do move into this double-headed monster of inflation or deflation. You just made an active decision that could cost you if history were to repeat itself. But again, the question, if you ask the question, the answers become more meaningful. And then lastly, superannuation and superannuants will adapt to these new challenges. So as bearish as we may pontificate about the economy, V-shape, U-shape, W-shape, we adapt. We live on. And we create a portfolio, if you like, that meets these uncertain times. Thank you very much.